Well, hello and welcome to Trading Hour. I'm Vivek Iyer, and with me today is Vinny Motiwala. Good morning, Vinny. Well, it's been an extremely volatile trading session as far as the markets are concerned. We were on track for the fifth straight losing streak as far as the Nifty, the Sensex were concerned. And in fact, if you look at the broader end of the markets, the mid-cap and the small-cap index, they're down for 4 straight sessions. But just in the last 15 minutes of the session, the Nifty has managed to pull back above the flat line and trading with very, very minor gains. Good morning. When you're looking at the market itself, remember today is an important day, given the fact that you're going to see quite a lot of passive fund flows that come into the market. This on the back of the fact that there are 2 index adjustments that will take place. The first up is the Sensex adjustment. Remember, Zomato comes into the Sensex today. Approximate flows of a little over $450 million, and these are IFL alt estimates, exclusion, and it is coming in at the expense of JSW Steel, which will see outflows of close to $250 million. Remember, these changes or these adjustments will happen in trade today, and the Sensex change effective will be from Monday onwards. Now, talking about the FTSE December review, remember, this particular review mainly pertains to IPOs and spin-offs. So Bharti Hexacom and Go Digit are the 2 inclusions to the FTSE indices. Net, taking into account all of these changes, as well as the weight ups, as well as weight downs, today is a net inflow event of a little over $150 million. And on the back of that, expect some positive flows, especially in the last hour of the session.
Absolutely. So surely that's what we're watching out for. Good morning to you as well, Vivek. Very volatile day. I just want to mark a couple of names, right? Vivek spoke about Go Digit also on that FTSE rejig coming in there. So we are expecting some flows on that front. But other than that, let's pull up some of these insurance names that we should be watching out for. We have General Insurance, New India Assurance, all these also are buzzing in trade. General Insurance as of now is up. GIC, that's up almost 8% in trade that we are watching out for. That is something interesting. New India Assurance also 6-7% of gains that we are seeing over there. In the broader markets, also let's watch out for some of these other names. BASF, there was news flow coming in here, so keeping an eye out on that. Aegis Logistics also is something that is moving in trade, as well as Metro Brands, Uno Minda, Lloyd Metals are some of the gainers in the mid and small cap side. Sector-wise, today what we're seeing in terms of a performance coming in, we have a Nifty Metal is a top sectoral gainer that we're watching out for, as well as a Nifty Energy and Nifty Pharma managing to hold on to some bit of a gain. In terms of drags, today what is not doing well, Nifty IT. And, you know, Vivek, weren't we expecting it to do well, given that Accenture actually came up with a good set of numbers in this quarter, plus upgrade in terms of guidance was something that was interesting, but despite that, Nifty IT
absolutely right. And you know, it's been a little bit of a surprise as far as the kind of sell-off IT has seen. Well, a couple of reasons that we could hazard a guess. The first one, of course, has to be the fact that IT stocks have seen quite a bit of a run-up, also a little bit of profit booking. A couple of brokerages have also pointed out to the fact that the internals, as far as Accenture is concerned, may be a little muted, and the read-through for Indian IT companies is something that indicates that the rest of FY25 you may not see those small tuck-in deals actually come in. So that is something that we need to watch out for. And other than that, also remember, especially as far as the Indian IT companies are concerned, this particular week and the last couple of weeks, they've seen quite a bit of a rally. So again, that is something we need to watch out for. But Sensex Pharmaceuticals IPO is set to open today with an issue size of 582 crore and a fresh issue which has close to 500 crore. To discuss this and more, we have Swapnil Shah, Managing Director at Sensex Pharmaceuticals. Good morning, Mr. Shah. First of all, thank you so much for joining us, and congratulations, you're coming on to the listed market. First up, take us through why is it that you're raising funds? What will the funds, as far as the fresh issue, be utilized for? And give us a breakup of that utilization.
No, thank you. Thank you for having me here. Good afternoon. Good morning, everyone. So we are raising 500 crores primarily. Largely, it will add our capabilities in the US. So currently, we have oral solids manufacturing in the US for specialty markets and government and controlled substance. With injectable coming in, we can look at multiple different growth drivers, pretty much keeping the same distribution channel that we have, create and do specialty niche kind of products, and just add our capability with the 100 crore investment that we have planned. 100 odd crores, we have planned to reduce our debt, so that will be paid long-term debt's going to be paid back, and the remaining is going to be GCP purposes and the issue expenses.
Sure, Swapnil. Good morning. This is Vinny this side. And Swapnil, what I want to talk about, you have also highlighted one bit of a point, if I'm not wrong, is in terms of funding of inorganic growth and acquisitions, right? Some amount is going to be used for that. Anything specific that you're looking at? Which segment will you be looking to grow in? And anything that you've already identified on that purpose as well?
No, thank you. Good morning to you. Yes, we have identified some products that we would like to acquire just to increase our product basket that we currently offer in the marketplace that we operate in. So discussions are ongoing. We would be looking at some inorganic product acquisitions. Nothing on the acquisition of plants or anything of that sort.
Okay. One thing that we've noticed is, especially as far as FY24 is concerned, there's been quite a bit of a jump up as far as revenues are concerned. We understand in the year gone by, you had a couple of acquisitions and that actually aided to the growth. So give us a sense of what could be steady state revenue run rate, because it will be tough to go ahead and extrapolate the backward data given the fact that there have been a couple of acquisitions.
Yes. So these were acquisitions. These companies became our subsidiaries last year, but they were largely run by us from several years in the past. It's just that it got consolidated last year to our list co. Talk about H1 numbers. So H1, we have about done 83 crores on the revenue side with about 24 crore of PAT. We expect going forward, our growth is going to be better than the industry averages that exist today. Largely driven by our niche segment, our unique proposition, unique positioning in the marketplace that we operate in today.
Okay, so then this is what we're watching out for. So the run rate now one should be expecting for would be what? The industry level run rate or better than that? What are we watching out for? And what is the industry run rate? Also in terms of margins is something I want to understand, because in the last few years, margins are also varied in the range of 17 to 46%, and in the last couple of years, it was 20%. So what is it that we're watching out for in terms of margins also?
So the way we realize our revenue is a little different than the other pharmaceutical companies that are realizing. So we work on a profit share basis with our partners. So we don't realize the gross revenue, which are typically our partner who sells the product into the end market, they realize it. That's why you said the variance on the revenue margin side. Secondly, we expect the growth to be more than the average industry, right? So a lot of products, as we speak, we have 51 products in pipeline, out of which 28 odd are CGT category products. So that will drive our growth, as well as on the CDMO, CMO side, we have tremendous tailwind in terms of how the market has shifted from what it was than what it is today on the CDMO, CMO side. So we feel a lot of tailwind on the CDMO, CMO, which will have our better than industry average growth.
Okay, Swapnil, you just pointed out in terms of the CDMO side as well of the business. So I know obviously in the US, there's a lot of opportunity that is building up on that front. There's going to be a change in terms of the government. Investors are concerned about some bit of a geopolitical issue coming in, or how this is going to shape up for the company. If you could indicate that, and how do we see this segment specifically growing?
Too difficult to predict anything, I mean, we keep on hearing different things here and there. I think for us, what is critical and how we are positioned is we have a manufacturing plant in the US, right? So that kind of helps us, so to speak. How things are going to span out, nobody knows. Nobody can comment on it at this point of time. But coming to CDMO, CMO space, we feel there is a tremendous growth that will happen on multiple accounts, as we have a government business that's happening from CDMO, CMO space, as well as controlled substance, where for those products, US manufacturing is mandatory, right? So we have vaults, cages, the entire ecosystem and the infrastructure is in place to access that marketplace. So we feel we'll continue to grow extensively, definitely more than industry averages that you will currently see account of this.
Mr. Shah, one quick question. Number one, what is the total debt on the books, or what is the finance cost at which you have taken up the debt? Given the fact that you will be utilizing a significant chunk of the proceeds to repay the debt, what will be the annual finance cost savings that we see over there? And also in the last 3 to 4 years, if you could give us a general sense of what has been the price erosion your particular portfolio has seen, especially as far as the developed markets are concerned?
So we have about 220 odd crores debt today as we speak. So I think we are going to repay about 100 crores of debt. That will tremendously help save on the interest part as we speak. As far as price erosion is concerned, we are not into para 4 kind of opportunities that usually large pharmaceutical companies are into it. We look at products that are for specialty niche category. CGT product which are already genericized. So once we get approval, the erosion has already happened, right? So that way we really provide a unique proposition to our partners in the marketplace. And all large pharma conglomerates are our partners. You know, I mean, they really want to continue to work with us purely because of the partnership and the uniqueness that we provide them in terms of marketplace.
Okay, Swapnil, thank you so much for joining in with us and hope to see you on the listing day as well. And good luck with the IPO. Thanks so much for joining in this morning. That was the management of Sensex Pharmaceuticals who joined us to talk about the IPO, which is opened up today. But on that note, we're going to take a very short break. And after the break, we'll discuss what's buzzing in the world of commodity with Manisha Gupta.
Welcome back to Trading Hour. Well, just some while ago, our colleague Sapna from Delhi had broken an important development as far as oil marketing companies are concerned. She had mentioned about how the oil ministry was looking to go ahead and do a recovery of over 25,000 crore as far as LPG under recovery is concerned. Our colleague Sudarshan has just put together some data which you can see on your screen. The total LPG under recoveries as far as H1 or the first half of FY25 was concerned was close to 17,500 crore. Now within the three OMCs, Indian Oil Corporation, IOC forms over 50% of the total LPG under recoveries. That totals to a little over 8,800 crore. HPCL as well as BPCL both form the remainder of the LPG under recovery. HPCL's LPG under recovery in H1 was close to 4,500 crore, while BPCL's LPG under recovery was a little over 4,100 crore. So this is a positive development in case it fructifies for all three of the OMCs, the bigger beneficiary being IOCL, given the fact that its under recovery is quite significant. But moving on, we'll now shift focus to the commodity space. Manisha joins in, and today we are focusing on natural gas.
Well, yes, I'm looking at natural gas today, and that is because the prices are headed for very strong gains in 2024. They're up by almost 48% at this point in time. And the strength comes in on the back of very strong demand factors. Also, when you look at the prices, these are the highest prices in 1 year that we are seeing in case of natural gas. This also is the highest annual gain that we have seen in the gas prices since 2022. One, you have seen strong winter demand. This is the period when we see cyclical gains as well. Second, the strong global LNG demand has been supportive. Three, there is uncertainty about Russia exporting its natural gas to Europe via Ukraine. So that uncertainty also is adding premium to prices. And then the US gas consumption is at near record highs for 2024. The markets also are looking at strong natural gas demand coming in from electric power sector. So the expectation is that you could be looking at higher prices going forward from here as well.
Okay, Manisha, thank you so much for that. But on that note, we're going to slip into a very short break. And once we return from the break, we'll discuss market technicals with Mitesh Thakkar and also discuss his top trading bets. Welcome back to Trading Hour on CNBC-TV18. Nifty as of now, 23,936 is what the Nifty is at, around that level. Flip-flopping between the red and the green. And, from that sharp recovery, we saw fall through the day and then again coming back in the green, but not holding on to a steady mark. But let's bring on board Mitesh Thakkar, our technical analyst, for a quick check on what's happening in the markets, understanding that as well as the stop bets. Good morning, Mitesh. What a volatile day. I don't know what levels are you keeping an eye out on, because the 24,000 doesn't seem to be sustaining for the Nifty. What should we be watching out for today as well as in terms of the Nifty going forward in the next couple of weeks?
So one, I think, with the last few days of decline, the short-term trend has turned negative. Today, my understanding is that, and I had highlighted this in the morning as well, that the 200-day average, simple moving average for the Nifty index is at about 23,835, and we got a low around those levels, I think 20 points lower than that. So with the kind of fall in the last 4 or 5 sessions, today being the 5th session actually, we are slightly oversold and close to 200 average. Could be that we'll get a bounce back, but to me the structure is weak. So I would still maintain a negative stance. Pullbacks to about 24,150 or thereabouts, 50 points here and there, I think would be chance to add on to short positions. We are trading through bear spreads, option spreads on the negative side. And I think because of the intraday volatility, futures can be avoided for the time being. And around 24,150, I would want to short again. And or either if we start closing below 23,800, then I think good chance that we'll go to about 23,500 in the worst case scenario, even retest the November lows of around 23,350. So the stance for the time being is negative, and sell on rallies or trade through put spreads is what I would recommend.
Okay, sure, Mitesh. We'll keep an eye out on those levels. Important to watch out for the 23,800 also, because if it closes below that, then we could see a further fall. That's what you're highlighting. Mitesh, but top bets that you're looking at today, you said you're avoiding futures, you're making the short calls. What are you watching out for in terms of bets?
Yeah, so on the stock side, I think, pharma and IT was something which we have been recommending, and IT has started correction today. So pharma still remains a bet on the long side. So I have one buy on the pharma hospital name and one sell call. SBI Cards is a sell for me. I think that's a stock which is slightly weakening. So keep a stop at about levels of 712 here and look for a target of around 680. While Apollo Hospital, that's a stock which is surging well now at the day's high. That's a buy with a stop below 73.30, and I would look at targets of around 7,500.
Thank you so much for that, Mitesh, and wish you a very happy weekend. Well, time now for a short break. We'll tell you why MTAR, Tech, GE, Vernova and BASF are buzzing in trade today on the other side. Well, welcome back to Trading Hour. Well, the brief respite we saw as far as selling was concerned on the Nifty. Once again, the Nifty is back in the negative. The Nifty now down 0.2%. But like promised, quite a few stocks in the broader end of the markets are doing very well. And one amongst them is MTAR Tech. The stock is buzzing on the back of a recent order win. Upasana joins in with more details.
Well, the stock remains in focus today on back of the order win, as the company has received orders worth 226 crores in clean energy and aerospace segments. Now, out of which orders worth 191 crores are from the company's key client, that is Bloom Energy, in the clean energy space. And 35 crores orders are from company's other clients such as Rafael, IMI Systems, IAI in the aerospace segment. Now, company has said that the orders worth 225 crores are expected to be executed within 1 year, and the balance will be executed by April 2026. And this order value reflects company's increasing market share in aerospace and clean energy segment. Now, recently, Motilal Oswal has given a buy rating on the stock with a target price of 2,100 per share. It says that it derives majority of the revenue, that is 60%, from clean energy segment, and most of it is coming from the company's significant client, as mentioned earlier, that is Bloom Energy. As the Bloom Energy transactionary impact of the product changes are over now, the brokerage expects the company to report strong growth in the near term in this segment, and this growth will be led mainly by the revival of orders from Bloom Energy and addition of the new client in the company's portfolio. It has also said that Bloom Energy is witnessing a surge in demand as it has signed a large deal with American Electrical Power to install 1 gigawatt of power over the next couple of years, and because of which there is a big revenue potential for MTAR Tech that is around 900 to 1100 crores. Hence, the brokerage is bullish on the stock.
Okay, Upasana, thank you so much for that. As of now, the stock is trading at the day's highest point, up 9%. But on that note, we're going to take a very short break. Up next, we'll discuss the market fundamentals with Unmesh Sharma of HDFC Securities. So don't go anywhere. Welcome back to Trading Hour on CNBC-TV18. We now have Unmesh Sharma now from HDFC Securities joining in with us to talk about the market fundamentals and its top sectoral pick. Unmesh, good morning. A very volatile day today. But 2025, what are we watching out for? Do you think this is something that we should be worried about? Given that obviously we'll see Trump taking charge as well in January, what is the market fundamental looking like? How is the setup looking like for the Indian markets as of now?
Yeah, so look, this looks like a trend which will continue. So the volatility, of course, it won't be as volatile as it is December because generally the volumes tend to come off a little bit. Though one thing one must note is that the quantum of selling from FPIs, which usually tends to die out in the second half of December, still continues. Now, having said that, what will 2025 look like? I think to a large extent, we believe that there will be a fair bit of volatility on that. I think, the aspect that you talked about, which is Mr. Trump taking over, I think one very clearly you can see from the Fed minutes as, what's happened with the Fed meeting as well, is that the expectation now for rate cuts for next year seems to have come off because the view is that it becomes a lot more inflationary, the policy, so as to speak, which means a lot more domestic spend, a lot of possibility of tariffs coming through. I think globally, this is likely to send some kind of inflationary pulse across the world, and that obviously is a bit of a concern. Will that affect growth or not is something that we may not see, at least in the first half of the calendar. So I guess we are likely to see a fair bit of volatility on that front.
Understood that, Unmesh. So one thing that we need to be prepared for in the coming year is volatility. Now, let's look at, a sectoral view. And yesterday you did see the results of Accenture come by, generally seen as a space from which you could take some cue as far as the Indian listed companies are concerned. What are your key takeaways there? And going into the next calendar year, do you think IT can make a strong recovery?
Yeah, so look, our view is, well, of course, not everything that Accenture does can be extrapolated, but as you rightly said, there is a fair bit of cue that you can take from that. We believe that actually, if you look at two things on IT, one is that I think now over three cycles, three mega cycles, the Indian IT sector has continued to remain relevant. We believe that will continue to remain, whether it is, AI, cloud, and all of these, I think we are adjusting quite well. Also, if you look at the way in which there are two big tailwinds, one is macro, where we expect that there will be a little bit of a bias on the rupee depreciating, especially in the first and second quarter of the year. So that should help as well. Relatively, it feels like the valuation comfort, as well as given the fact that we also have a broadly cautious stance, which is what I was talking about. It feels like the large cap IT would be the place to be for the year. So if you look at our model portfolio and our top picks, top tier IT is definitely top there.
Okay, top tier IT is surely something that one should be watching out for also in 2025. Unmesh, a sector right now that has not done well this year is FMCG. It's not something that has performed. Commentary also has not been too exciting. What is it that one should be watching out for from FMCG side? And anything like, the top companies is something what one should look at, or as of now, FMCG would be an avoid for you?
So what's happened is that I think after the election, there was a little bit of a rally because there was this expectation that given the fact that there was not a single party majority and, after some of the state elections, there was a view that the the view amongst the incumbent parties is that there should be a lot of spend in the social sector to be able to get elected, and that led to a little bit of a rally because there was a view that unlike the past where the government was a lot more focused on capex, there's a little bit of shift towards the social sector. Now, having said that, that's kind of started to die out because of two things. One is that the consumption basket to a large extent has become like a barbell, where it's very, very heavily skewed to very top-end consumption and very skewed to very bottom-up consumption. So FMCG in that sense should be okay. But what's happened is that all the tailwind which has come from the margin expansion has kind of gone now and is in the base. So it feels like we are looking at high single digits, early double digits kind of growth. In that scenario, it's not as exciting. So what we've instead done in our model portfolio is that while last year we were cutting our underweight on FMCG and coming closer to the mean, we've kept it there, but we've kind of increased our weight on the discretionary. The way you would do this is that if anyone is delivering less than 12-15% earnings growth, then we are not really excited about that because valuations pretty much across the board are well in excess of 35-40 times. So FMCG, yes, but earnings needs to come through, and there will be no tailwind from margins there.
Understood that, Umnesh. Umnesh, one particular pocket that's seen a bit of a bounce in the last week or so has been the pharma pack. Also benefits from a weaker rupee, so tailwind over there. Do you think that is one pocket where you see incremental opportunities?
Yeah, so pharma, we've been doing quite extensive work. We have a new analyst on board as well, pharma healthcare, including and expanding that even to the retail on the domestic side. We are very excited about domestic. We are very excited about the things like retail of pharmaceutical medicines in India. Specifically within the US, I think we've upgraded Cipla. To a large extent, pharma on the tailwind, there are two things. One is in a risk-off environment, it tends to work. Then there is the rupee depreciation. Also, a lot of Indian companies now have gone past that problem that they were facing with the FTA. But what we are then looking at is what are the therapies that they're offering and what are the drugs. So it's a very bottom up in that sense. But this is a great space to be looking for ideas right now for calendar 25.
Okay, Unmesh, thank you so much for joining in with us. And if you do not connect with us again, a happy new year to you as well, and hope to see you in 2025 soon. Thank you so much for joining in with us this morning. But on that note, we'll slip into a very short break. And after the break, we'll bring you the management of NCC, Neerad Sharma, joining us to talk to us about the outlook of the company and what is the way forward.
Welcome back to Trading Hour. Well, let's now shift our focus to NCC. In November, the company secured a letter of acceptance for EPC work in execution of a portion of the Ken Betwa Link project. In Q2 FY25, they saw their revenue surge 10%, while EBITDA grew nearly 46% on a year-on-year basis. To discuss this and more, we have Neerad Sharma, the head of strategy at NCC, joining us now. Good afternoon, Mr. Sharma. Good morning, Mr. Sharma. Still have 10 minutes to go for afternoon. Thank you so much for joining us. First up, take us through this particular project itself. What is the kind of opportunity that you're seeing from this particular link project, and what more is in the pipeline as far as river linking is concerned?
Very good morning. Pleased to be on your show. This project is a very ambitious part of, the project that the country has been talking about for, more than about a decade now. What this whole scheme attempts to do is to, connect the areas where the water is, maybe could be lead to some flooding, excess water supply, to the areas where water continues to be a very scarce commodity. So as we speak, across the length and breadth of the country, there are parts in which you get a lot of floods, seasonal floods in couple of months, and there are parts of the country that continues to be water deficient for several months. So what this scheme intends to do is to bridge this gap between. Coming back to this scheme, this is the first package that has been announced for interlinking these two rivers, that is Ken River with the Betwa River. The value of the project is about 3,389 crore, and this project is required to be completed in 6 years' time.
Right. Okay. Mr. Sharma, do hold on with us because there's an exciting launch that is happening from the Bajaj front as well, the Bajaj Chetak electric scooter, and I expect it to be launched today. We can see the unveiling going on the screens as well. I see 4 colors coming in for the Bajaj Chetak as well. And we have this is going to be competing with TVS iQube, Ola S1 Plus, Ather Rista are some of the other competition that is there. Let's watch out for the pricing also in terms of the details that is expected, because this gives Bajaj a very good position in terms of expanding its electric two-wheeler market. You can see the visuals coming in on your screen as of now. And yes, that is Bajaj Chetak, the launch of the electric scooter. But Mr. Sharma, let's continue the conversation. Surely we saw one more EV bike coming in. I want to understand a bit more in terms of this project for yours, Mr. Sharma. Margin profile, how does that also shape up? You gave us, how this project will work out for the company. What are we watching out for in terms of margin profile versus the other projects? What could you give us an indication in terms of that?
Margin is a little difficult, to predict at this point of time. As I have brought to your attention, this project has just been awarded, and this project is something that runs into 6 years' time. So, give us some time. We have just been awarded the project. We have to now prepare a detailed project report. There is a lot of planning. There are a lot of clearances, permissions, which are required from the different government bodies. Once we, start the project, once we, make some progress, I think that would be the right time to talk about the possible margins. Possibly it's too early and premature to talk about the margin that we will, end up with after 6 years.
Sharma, I just want to interrupt you there. At the end of Q2, the order inflow that you saw in Q2 was 4,670 crore. The order book was a little over 52,370 crore. Post Q2, which are the projects that you've been awarded? So what has been the order inflow so far in Q3? Where does your order book stand currently? And what are the orders in which you are at the L1 position?
Firstly, as we speak, we have already bagged projects close to 12,000 crore. And I also take this opportunity to share with you the fact that at the start of this financial year, we had shared one order inflow target with the street, which is a band this time, 20,000 to 22,000 crore. And we have already achieved about 55 to 60% of this lower band. So we are on our way to really achieve this order inflow target that we have shared with the street. Now talking about the second part of your question was about L1. We have L1 projects close to about 9,000 crore.
Okay, so L1 you are close to 9,000 crore. You've already achieved close to 60% of your targeted. So now, as we are standing at the cusp of the end of Q3, just around a quarter to go, what is the kind of order prospect pipeline that you are seeing? Which are the orders that are coming up for tendering? And typically, what is your win rate? So that will give us an indication whether you will be able to go ahead and beat the order inflow guidance.
There are a lot of projects, we have 4 large divisions, which is buildings, transportation, electrical, T&D, and water division. The order book that you just talked about, that is, 52,370 odd crore. About 90%, comes from these 4 large divisions. And we expect this trend to continue. So most of the irrigation, I have already shared with you the project that we have bagged. Possibly we might get a few projects in the railway, but these 4 large divisions are the ones which are going to contribute to the order inflow guidance that we have shared with the street. And we are reasonably confident and optimistic to, achieve the order inflow guidance that we have shared with you.
Okay, Mr. Sharma, thank you so much, for joining in with us and talking to us about the company, the outlook of the company going forward. It was a pleasure having you on the show, as always. But with that, we are absolutely out of time on this edition of Trading Hour on CNBC TV 18. Thank you so much for tuning in. But up next, we have Halftime Report after the break.